Good morning. Good morning. Cameron Dawson, Chief Investment Officer, NewEdge Wealth. Cameron, how you doing today? We got a lot to talk about. We'll just go overall broad market perspective here. Just a rally that has just exceeded everyone's expectations. And we're just back at the lows from last week. I mean, no big deal. Why is everyone so upset? What's going on?
They're upset because they're conditioned to such low volatility. We've been in this unflinching up and to the right kind of market. And so when you get a little tiny ounce of volatility, it just feels so foreign to the world that we've been in. On the one hand, this market absolutely demands that you respect the trend, meaning that the trend is up, and every time we pull back to trend, you see buyers step in. It doesn't mean that you can ignore certain risks. It doesn't mean that you can ignore some of the deterioration you see under the surface in pockets. But overall, until we see signs that the trend is truly deteriorating, that you're seeing more distributive types of patterns, that you're starting to see some decaying in the fundamentals, which we can talk about, we're still in the respect the trend camp. And that means, though, is that you can have an uptrend and still have pullbacks, and it's perfectly normal, perfectly healthy.
Okay, there's a lot to cover here. The narrative is constantly changing in these markets, but I looked at your Monday charts and I'm going to show them here. And you started out with, look at the news that we've had, the political news in the last couple of weeks, and we were trying to identify Trump stocks, Biden stocks. Well, no, it's no longer Biden stocks. Now it's Harris stocks here. I like to look at this predicted. I see you have it up here. You got it nice graphically here. Let's just talk about like politics. I mean, we're away from a major election. We've had a historical change happen. There's Trump stocks, there's Biden Harris stocks, or just tech stocks. Talk to us about the political environment.
Well, one thing to encourage is that you can put these buckets of stocks that benefit from different policies together. The market does have a propensity, though, to front run and pull forward a lot of those benefits. I lived that when I was covering the industrials. It was a great example back in 2016. Everybody thought we'd get all this stimulus on infrastructure. Industrials ran up mostly in the 2 weeks post the election, made a new relative high versus the market, and quite interestingly, have not made a new relative high since. So that peak was in 2016. So it's just a good reminder that, yes, you can see these things move around. There's some stocks that will definitely be correlated to the polling numbers or the betting odds. But for the most part, it's you kind of take it with a little grain of salt, because you can see a lot of pull forward, and it could be a buy the rumor, sell the news kind of situation.
Yeah, boy, I'm thinking about the weed stocks, and I'm thinking about the solar stocks back in November, and those moves were just unprecedented. Let's move on. Everyone's talking about bad breath, right? The rotation, relative strength here. The people that were waiting for that IWM, they're perhaps getting their moment. I haven't checked the quotes. The S&Ps are still leaking here. Talk about the breadth of the market and how this is maybe actually a good thing, the kind of correction in the rotation that we're seeing.
Yeah, it's no surprise. The market got really overbought at the beginning of last week. And so to see it pull back to trend, at least the 50-day moving average, maybe the 100-day, like we got a little bit in the beginning of the year. Again, it's all very well and normal. And I think the test then comes is, how much gusto do you respond out of the correction period? Of course, we saw really strong reactions coming out of the correction earlier this year, of course, back in October of last year as well, which set up for the next leg of the advance. Now, to your point, you are seeing these pretty powerful rotations under the surface, and some of them are more powerful than others. Right now, we think that they are driven purely by positioning and not necessarily by fundamentals. So if we're thinking about that IWM rotation, you can measure it through things like ETF outflows from the largest small cap ETFs getting to an extreme back a couple weeks ago. You can look at CFTC positioning in the Russell 2000 being at its lowest level level since 2022, not quite as low as it was back then, but still, pretty pronounced in short positions. So that snapback is what is really fueling that uplift. And the question, and the biggest question, is can it be sustained? And that's where we think we have to turn to the earnings line in the Russell 2000 in these unloved areas to get a sense of, is this more than just a 1 to 2 month kind of move like we got at the end of last year, or something that looks a lot more akin to, let's say, 2020, where we had small cap leadership for multiple quarters. We lean towards there's still some big question marks on the fundamentals, which we can dive into.
Okay, I just pulled up, or I am pulling up the momentum surge here in the Russell 3000 names at the 20-day highs. Very
Show it again, Joel. We can't see it now.
got to add. Boom. Thank you. There we go. The momentum surge here. Boy, just I mean, unbelievable chart. Talk about what you're looking at here, and then talk about the recent volatility here. And I mean, the VIX has had its spurts and stuff here. Just talk about how the two things go together.
Yeah, so this momentum surge, if you talk to the technical guys, and quoting Jeff DeGraff here, he calls it momentous momentum. When you see a huge amount of flows into stocks that everybody's clamoring to get in, you see a surge in 20-day highs, and that typically is followed by a period of stronger forward returns, because it signifies that people are racing and rushing to get into the market. The thing that's really unique about this surge in 20-day highs is that it's not coming after a corrective period. It's coming actually after a pretty powerful advance. So when the market was already overbought, you were seeing this surge in 20-day highs. I don't know if this is the exception to the rule. I think it really remains to be seen. One observation is that we see some more of these breadth thrusts recently than we have in prior periods. Maybe it's just the velocity of the market moving around, but it's something to keep in the back of the mind that typically it is a bullish signal, but of course it is the confluence of evidence that we have to continue or could consider. To your point, Joel, on volatility, it's another one of those examples of you're in a very low volatility environment that creates the setup for a higher volatility environment. So maybe not quite the Minsky moment of low volatility breeds high volatility yet, but there is an aspect of seasonality to volatility. This is typically a time where we see vol pick up. So again, not all surprising. It just feels very foreign simply because we've been in this ultra low vol kind of world.
And I mean, I think I saw a stat, maybe you know the stat, but it's been like 300 days since we've had a 2% drawdown in the S&P. And I mean, obviously we're starting the day down 1%, so maybe today is going to be the day if we get follow through here. But it never seems like that. It just seems like the mentality of this investor or trader is like, I buy dips and I win money. And I mean, I don't know how you break that.
I think you break it with the fundamentals and the earnings or liquidity. So to address the liquidity one, Dan Clifton over at Strategas has done some pretty incredible work on trying to, I call it the 10 hat analysis. You kind of have to believe in these liquidity conspiracy theories about TGA drawdown, reverse repo drawdown, how that impacts overall liquidity. But there are ways to measure to say that there has been a liquidity support for this market, which has helped it sustain and tolerate any kind of uncertainty in the headlines. The other aspect that I think is really important is that if you just look at the chart of the 12-month forward EPS line, it's still going up. Now, we could argue that the only reason 12-month forward EPS is going up is because you're including more of 2025. Each month you go forward, you get more of 2025 in that number. So it lifts just because the calendar effect. But I think the key thing to watch is that we think that 2025 estimates are too high. And so they're at $277 a share. I think that if you were to identify a risk into the back half of the year into 25, the risk to us would look like you go into an EPS cutting cycle, you have to trim estimates, and that line of 12-month forward EPS starts to flatline and possibly starts to turn over. And then it hits these really high valuations, which you just pulled up, which is that you look at valuations for the S&P 500 or for tech specifically, are very elevated. So the key risk would be is that you have a slowing trajectory in EPS because estimates are too high, running headfirst into high valuations. And that could be your setup where, Dennis, where people are less likely to want to buy the dip because you're not in this rising growth forecast and still room for upside to valuation environment.
So
I just
Cameron,
find it interesting when I'm just reading your slide here as well. So the only time tech has been more expensive was during the 1990s tech bubble. I mean, there's a scary thought there too. I mean, I think during the tech bubble, I think the NASDAQ was 45 or 50 times earnings. Maybe you know the stats. I'm going from my memory. But so obviously we were a lot more elevated than this. But, if you're putting new money into NVIDIA at this point in time, or putting new money into, obviously a lot of these other tech stocks at this point in time, we might be a little bit late to the party, aren't we?
Well, given where valuations are, I would argue that valuations have hit a ceiling, but I would have argued as well, obviously incorrectly by this chart, that valuations wouldn't retake the 2021 highs,
They
meaning
did.
that 2021 was a time when you had incredible euphoria in markets. You had huge policy support. Rates were zero. Of course, there's a degree of euphoria captured in things like AI, and a lot of the last, let's call it 3 months of moves in stocks, weren't being driven by earnings revisions moving higher for tech names. It was being driven just by multiple expansion and positioning chases. So the thing to contemplate going into 25 is that you get a pretty big second derivative slowdown in the pace of earnings growth. You look at the Mag 7, they go from about 46% earnings growth on a cap weighted basis today in 2024. That decelerates to 20%. Usually markets don't like second derivative decelerations, meaning that, yeah, you're still getting earnings growth, but if it's at a lower pace, maybe I pay a lower multiple. So that would suggest that maybe you are a little late to the game, but we also can't rule out, 1998 is a great example of Fed cuts rates and market goes absolutely berserk, moving higher through the peak in March of 2000. And here's the most fascinating part about that time. Growth earnings actually underperformed value earnings in 98 and 99, which meant that it was all valuation expansion. It was all bubbly kind of behavior. So that is a tail risk to the upside for this market. We know the Fed wants to cut. Look at Dudley coming out this morning saying it's time, Fed has to cut. You can't rule out a irrational exuberance kind of rally melt up, which is why you have to be balanced of, yeah, there's a lot of downside risks, but there's also upside risks.
So Cameron, I mean, speaking on on this subject, we've seen the RSP, the equal weight S&P 500, kind of underperform the actual S&P 500 for the last year or so. Because if you weren't in the big boys, you weren't seeing those big gains. Are you starting to see that trend shift right now, or is that too early to tell if it's going to start coming back a little bit, the RSP?
Yeah, we say, too soon to call it a trend change. You've seen a little bit of a lift in the relative performance, but not a lot. This can be explained by earnings as well. Cap weighted earnings, because of the Mag 7, have significantly outperformed the equal weight earnings. And I saw a stat this morning, and I wish I could remember who I saw it on Twitter from, or X from, saying that the correlation between the equal weight and the cap weighted index is one of the lowest on record. Usually it has a very tight correlation because it's the same stocks, just with different weightings. And that's fallen to about a 0.36 correlation in the last few months, which is it just speaks to the degree of absolute and complete narrowness. But we think the market can stay narrow as long as earnings stay narrow, and that you have to see the broadening out in earnings. The point, though, I think that's important in that is that broadening out in earnings is already being contemplated in current earnings estimates. So the market now has, if you look into the fourth quarter and first quarter 25, the market has the average stock outperforming, the 493 stock outperforming the Mag 7 by the time we get to the first quarter. So if we don't see that materialize, you actually have an earnings revision down cycle for the 493 that could keep the market narrow. So that's why we have to watch that earnings line and earnings revision super, super closely.
Okay, one more here before we let you go, and this has to be, I think, the favorite one of all these fantastic charts that you sent us here. And we've had a very unusual time period here since 2020. You do a great job here. I'd like you to put 2024, the rest of the year, and 2025 on top of
Yeah, we
that.
want to see what's coming.
Yeah. Wow, what a divergence here.
Yeah, look, it's absolutely incredible. And again, it just speaks to that if you look at all the areas that have the best returns, it's because it's the areas that have had the most earnings growth. The best, or the best reminder to have is that you typically get double whammies to the upside and the downside. The double whammy is that when earnings growth is superior or accelerating, you get multiple expansion. When earnings growth is inferior or decelerating, you get multiple compression. And I think that is the key wild card for 25, is that can you see the same kind of leadership if you're seeing a decelerating kind of earnings environment? Do you get multiple compression off of these super high levels, which could cause a leadership rotation? I think it still very much remains to be seen. And it's one of the reasons why our view on things like tech is that you have to let your winners ride until you see signs that the trend is deteriorating, that you're seeing a breakdown in the trend, and that buy the dip mentality has evaporated. I think that this market, as we started talking, has been demanding that you respect that trend. So, one of the things we're watching closely for is the breakdown in some of the semiconductors that have deteriorated versus trend. So there's some red flags that are brewing that could set up for a very fascinating end of 24 into 25.
That is an understatement. Cameron Dawson from NewEdge Wealth here, joining us here on Pre-Market Prep, breaking down the fundamentals, breaking down earnings growth, earnings expectations. That's what we need to talk about more. Thanks a lot, Cameron. We'll be talking to you again real soon.